A economia europeia enfrenta desafios como a inflação, o envelhecimento da população, a transição energética e a crescente competitividade global. Ao mesmo tempo, beneficia de uma forte ligação entre países, inovação tecnológica e investimentos estratégicos que procuram fortalecer o crescimento sustentável e a resiliência económica da região. A economia europeia é o tema do nosso próximo debate. Para moderar esta conversa, chamo José Barreto, partner da Goldman Sachs, e para participar nesta conversa, Álvaro Santos Pereira, Governador do Banco de Portugal, Klaus Regling, o primeiro diretor do Mecanismo Europeu de Estabilidade, Phil Hogan, antigo Comissário Europeu para a Agricultura e o Desenvolvimento Rural e antigo Comissário Europeu para o Comércio, Valentino Valentini, Vice-Ministro do Ministério das Empresas e do Made in Italy.
Obrigado, Patricia. And good afternoon, everybody. I think we managed to mess up all the seating, which is a great start. Anyway, good afternoon, everybody. Truly memorable event. And thank you now. And also thank you, José Manuel Barroso, for persuading me to be a moderator for the day. And more importantly, for gathering the remarkable group of global leaders in our country that we have seen today. Throughout the day, we have heard unique insights on defense and geopolitics, AI and new technologies, and development, equality, and justice. Across every panel, the same pattern emerged. Extraordinary opportunity, sitting right alongside real and complex challenges for Europe and for the world. That brings us to the question, how can the European economy prosper in the new world order? And let's do something economists sometimes struggle with, which is spin it into the positive and stay optimist. I think I'm really honored to welcome four people that I think will provide unique insights and are very well placed to answer this question. We have, to my left, Klaus Regling, effectively built the European Stability Mechanism from scratch, deploying 300 billion euros to keep 5 Eurozone's economies, including Portugal, from the collapse. So welcome, Klaus, and thank you. To my right, I have Governor Álvaro Santos Pereira, who was Portugal's economy minister during the Troika years, implementing the reforms that turned our country around. He's now governor of Bank of Portugal and a member of the ECB Governing Council, helping set European monetary policy. So welcome, Governor. To my far right, Phil Hogan. He served as EU Commissioner for Trade, managing over 3 billion euros a day in EU-US commerce and sitting across the table from Washington during the first Trump trade war. And then at the very left, Valentino Valentini is currently Italy's Deputy Minister for Enterprise and Chair of OECD's Digital and for SMEs initiative. Italy is one of Europe's great economic powers, setting global standards in design, engineering, and industrial craftsmanship. And I'm sure Valentino will be able to share unique insights on how can Made in Italy survive in the new world order. So I'm going to start on my left here with Klaus. Klaus, Europe faces four enormous investment demands simultaneously: defense, energy transition, tech transition, and AI. The numbers are staggering. The Draghi report points to something close to 800 billion euros per annum, which is the equivalent of about 5% of GDP. Where does the money come from? And is the Capital Markets Union the answer, or is just the answer we love to keep talking about?
Well, thanks for the question, and thank you for inviting me, José Manuel. Always a great pleasure to be in this country, in this city, and particularly to see today how the country is really doing very well. I remember how it was 15 years ago, but we may come to that later. So you're right. The investment needs are tremendous, and many other things are important that were discussed this morning. The world order is changing. Europe has to find its place in this new world order. The way Europe organized itself the last few decades worked very well in the past because it was a multilateral order where the EU, which is multilateral itself, fitted very well into that. Now it's all different. We discussed it this morning. I will not go into details unless you ask more questions. Clearly, one response, apart from reforms, are these huge investment needs. And your question was where should the money come from? Where can it come from? The good answer is it's doable. The money is available. The savings are tremendous that we in Europe generate. The problem is that over the last few years, a lot of those domestic European savings are leaving Europe. You can see it when you understand the relationship between current accounts, trade service current account, and capital account of the balance of payments. The balance of payments has to be balanced, like any balance, because we had for decades current account surpluses. It also meant for decades Europe has exported capital to the rest of the world. Every year, it fluctuates, of course, between 300 and 500 billion euro per year. So if you find a way to keep that money in Europe, then we have already paid half the bill. And that's doable. And we get to Capital Markets Union in a moment in that context. But in addition, we could make Europe more attractive for the rest of the world to invest money here. And that means making the euro a more important currency in the world economy, in the international financial system. The world is waiting for that because they are slowly moving away or they are discouraged by what they see happening in the United States. So they are looking for alternatives. But the euro at the moment is just too complicated because euro area, 21 countries, not 27 like the EU, but 21. But that means if an investor, let's say in Singapore, wants to invest in every euro area country, that investor would need 21 tax experts, 21 experts on insolvency law, and 21 experts on banking and financial market supervision. So that's not very attractive. In the US, it's one of the three each. If we create a capital markets union, savings investment union, however we call it, then the objective is clear. So investor in Singapore needs only one expert on taxes, one on insolvency, and one on financial market and banking supervision. And then the euro will become more attractive and more capital will flow into Europe. So two things. One, first task, keep the savings that have been flowing outside Europe, keeps them here. And second, makes the euro more attractive in the euro area so we get more savings from the rest of the world.
Okay.
All that requires structural reforms so that our economy performs better, plus creating the capital markets union to make it possible.
Okay. Thank you, Klaus. Valentino, Italy talked about collective financing for defense in EU. Is that also part of the solution in your view? Is it something that will also contribute to solve this funding gap that we're seeing given all the agendas that currently we see in Europe?
Collective financing is definitely the starting point, but it's not the solution. Collective financing works just as long as you have collective projects, and as we heard during the previous discussions, first of all, you have to create an architecture whereby you direct investments or you really create a European industry. If you look in aggregated terms, we spend just as much money as the United States do, but we have 27 different armies, 27 different weapon systems. So the first thing is, yes, collective capital. Second, the creation of an authentic defense industry, and that involves some kind of planning and seeding of sovereignty. And the third biggest problem, I think, and I will say it here openly, is the fact that in the public opinion, there's not general acceptance of the fact that defense investments equals investment in improvement and in technology. They see that as a dichotomy. Either you invest in social projects and every money spent for defense is taken away from the livelihood of people. And that's another very important element, because politically it's very hard to defend. You can defend it in Brussels, but then when you go to the domestic capitals and you see elections, you see people that then votes against that. So we also have to convince people that the industrial military complex exists, and that in a world which is dual use, everything is dual use today, every money that is spent in defense is just as well spent for industry, and it's also spent for progress overall, notwithstanding the fact that we all need common defense because of the geopolitical reason we all heard. But certainly on the political arena, the debate is there, whether investment in defense is really an investment, or rather is money spent that takes away from the livelihood of and the commonwealth of the people.
Perfect. We talk about the growth agenda and how to fund it. We'll come back to that. I wanted to turn to my right and talk also a little bit about resilience. Governor and Klaus, you both lived through the last financial crisis from the front line. If there is another financial crisis, a sovereign debt shock or a banking contagion, an external disruption, Governor, is Europe better prepared than it was in 2010? And what really keeps you up at night? What do you think that can go wrong currently in the economy in Europe?
Well, first of all, thanks very much for the invitation, for being here. I do think that Europe has a potential that is not realizing. I think we heard this before. In particular, when I compare, we compare what is happening right now in one of the greatest revolutions we had in the past few decades with the general purpose technology called AI, the previous panel was talking about that will lead to significant productivity enhancement across the world. I see Europe far behind what I see in China and I see the United States. And if you look at, or even Korea, if you look at data centers, R&D, most of the variables that matter for the development of AI, I don't see Europe there with its significant numbers. And the question is, why is this? If we have so much savings, why aren't we channeling this to innovation? And so I'll get to your question in a second. I'm just trying to say that I think one problem that we have in Europe is that very often, even though we have a history of innovation, we are not letting innovation flourish. In particular, we are not letting our companies, when they get to the seed capital is okay, but when they scale up, we are not getting there. And so I'm very concerned because we have already a huge productivity gap between the United States and Europe. It has increased in the past 5 years because of a plethora of reasons not related to AI. And this will only increase. And this will have a significant implication for monetary policy, for financial stability, and so on. But in particular, I think we'll have a big implication for Europe. So going back to your question, are we much better prepared than we were 15 years ago? Absolutely. For a variety of reasons. We have, in terms of financial system, we have a system in terms of supervision, in terms of resolution, in terms of rules, that's much stronger, the architecture, much stronger than it was 15 years ago. And secondly, I do think that Europe undertook some important reforms at the time. And then, we're getting the price. The problem that we have in Europe is, besides not having innovation, is that we are not doing what the best countries do, which is a reform attitude that is always insatiable. Be unhappy of where we are and being able to understand that we need to reform, constantly try to reform so that we get better. And reforming in Europe very often, both at the national level and at the European level, has been a nightmare, or at least very difficult. And this is not helping us to create a common area, or to complete the common area. And so I think this should be a top priority. Remember, we have two big victories in Europe in the last few decades. We had the single market in '92, and we had then the euro, that everybody thought that the euro was going to be a disaster. Well, we are here and getting stronger. But what we need now, in my view, besides the innovation and the reforms that I mentioned, is exactly to complete the single market. For us, this should be the top priority because we have many areas in which we need to complete the single market to increase the resilience and robustness of the European area, to have more innovation, and to have a business area or an area that is more friendly towards business.
Perfect. Single market then is your wish for the next coming years.
I would like to see that.
Excellent. Let's move into trade, Phil, and global commerce. The EU-US trade deal established the 15% tariffs on most European goods. China is deepening trade relationships across Asia, Africa, and Latin America. The global trading order that Europe was built for is fragmenting. You negotiated on behalf of Europe at the WTO and with Washington. Is Europe holding its own in this new world, or is it losing ground? And I'm also curious to know that, is there anything, if you're sitting at the table this time around, is there anything you'd have done differently if you were sitting there?
Well, everybody does things differently, so I was the same, I'm sure, as the people that are there today, so I'm not going to get into that conversation. Everybody has their own style, but at the end of the day, the transactional relationship that we see now between the US and the rest of the world, Europe is caught up in that as well.
Yeah.
And we have to adapt to that reality about what happens. 3 trillion is being traded annually between the United States and Europe, massive amount of trade. And that trade will continue, in spite of whoever is in office, either in America or in Europe. That will continue because people are going to be traders. And I'm very pleased that the European Union is continuing to show an open trading position rather than a protectionist position, in spite of some of the rhetoric that you can see from time to time in politics. But I think the deal that we've done in South America with Mercosur countries, with India, with Australia, and I think by the end of 2027 we'll have 3 more in Asia, in Philippines, Malaysia and Thailand. All of that means that we're going to have the opportunity to get cheaper raw materials to make us more competitive. 2/3 of our raw materials for European industry and manufacturing comes from outside the European Union. Now, you would think it was the opposite when you'd hear some people speaking, but we depend on the people from outside. Well, we want to get the products in good quality, but also with less duties and less taxes in order to help our industry to be competitive. We have to have an each way better with the Chinese and the Americans. This is the reality. We have to handle the Chinese situation sensitively because Mr. Trump, President Trump, has said that he wants us to decouple from the Chinese, and at the same time he wants to do deals himself with the Chinese on rare earths and conflict and very important minerals for his own industry. We have to do the same. Secondly, the Chinese have overcapacity. We have to handle that through the various tools that we have, and we're doing that with trade defence measures for overcapacity and for subsidization of particular sectors that we are taking action against. But also we suffer a bit as well because we depend on China geo-economically for all of the rare earths and critical raw materials and solar and all of these other elements of our manufacturing base that are essential to build up. But at the end of the day, I think an open trading system, by making ourselves more competitive, is going to make sure that we're going to have the type of investment opportunities of the future. Because investors, wherever they're going to come from, as Klaus has said, we have to be competitive and we have to get better return on our money. And we have 10 trillion in various bank accounts and savings around Europe. How do we mobilise that? And I hope my friends in Ireland are listening to me, because in the Irish presidency, I hope they're going to make this a priority for the Savings and Investments Union, and to be a little bit more flexible, like some other countries in Europe, about this subject in recent years. I think it's imperative we mobilise this money. Also, we have new priorities on the multi-financial framework, but I can tell you that the Prime Minister of Portugal, Mr. Montenegro, when he talks about the common agricultural policy, he will not go to Santorini to the annual exhibition of farmers, and Aston Sow is here as well, talking about a cut of the agricultural budget. So the choices have to be made politically when you take all these things into account. So that'll be the challenge. Politics, at the end of the day, is not a theoretical business. It's about human beings, as the previous panel has said. And they have the votes, not the AI.
let's actually just finish this topic with Valentino exactly going into the people and politics. Valentino, you sit today on about 700 billion euros roughly of exports of made in Italy industrial goods. How do you feel? Do you feel optimist? Do you feel the pressure? What is your view?
Oh, okay. 1/3 of Italian GDP comes from exports, and that testifies to what we just heard. We need open markets. In a trade war, there are no winners, there's just losers. And of course, we have to balance between an open market and the necessary protection against a series of distortions, very strong, that we see nowadays, geopolitical tensions and all the rest. I would also like to add to another point. You see, China at the moment, which is one of the big problems that we have because of their overcapacity and their need for markets, risk to kill the chicken that laid the golden eggs. That is to say, what do the Chinese want? Our market. But if they keep pressuring and destroy our market, they take our market, they will take it away, and they will not be creating a different market for their own products. That is to say, world of trade needs a balance, an equilibrium. We try to work for that. Trade will continue to flow, but of course there are very strong tensions. We try to protect. We'll have to protect certain sectors, but remember that tariffs are not there to increase our tax returns, but rather are there to counterbalance certain distortions. That's another element that's important that has to be understood. Of course, there's a rewiring of global trade. We heard it. New markets are being opened. New ways are being found to keep this trade flowing. So if we are able to manage the current situation, which is quite difficult, I think that we will continue to along the importance of the development of trade activities. And that's why Italy is in favor, as is Europe, of an open market policy. We do not think that protectionism is going to help anybody except for very specific, determined and defined sectors and during the defined area, because otherwise protection is going to kill yourself as well. If you keep your sector protected, they will not be able to compete. Given the fact that we do not have enough domestic capital that's investing in our economy, so we have to make sure that to have a vibrant market, we have to have a vibrant economy and companies that continue to grow through trade, of course.
Perfect. I think we've spent the day talking about AI, and of course we would want to also touch on AI here. We'll try to cover it in a slightly different way than what we've heard during the day today, and primarily from also this numerical standpoint. I think if we look at a couple of data points, the US last year invested over $250 billion in artificial intelligence, 20 to 25 times more than Europe. This probably also goes into some of the innovation topics we're talking about. China produced more AI patents than any other country over the last decade. Europe produced only 3 notable AI models in 2024 versus 40 in the US, 15 in China. But then Europe has the AI Act, the AI factories, and more AI talent per capita than any other country, and actually ends up exporting a lot of that talent to the US and to Silicon Valley. Phil, I'll start with you, and let's try to be brief so that everybody can opine on this topic that is a hot topic. Is Europe a serious player in AI, or is it just setting the rules for a game that it cannot win?
Well, I don't think it's starting on the basis of, from a European perspective, we've been slow to actually develop the technology investment in research and innovation to the extent that the figures that you have pointed out from other jurisdictions have been. So we're playing catch-up. But the reality is 4 out of the top 50 in the supercomputing area of the world only come from the European Union. So we have to look at the priorities that we should be to take, at that same time taking account of the fact that we are well behind. So how do we adjust and adapt to that? It means that we have to regulate the investment opportunities that are coming from elsewhere in the European Union. We have regulated with a more benign way than we have been in the past in order to ensure that we get some of the opportunities and positives competitively for the implementation of the new technologies of the world. I don't think it's fair to say that we're going to be able to catch up on our competitors around the world at this stage. So Let's adjust to the reality and use the technology to the best advantage for our workers, for our companies, and to create the jobs that we need in Europe.
Perfect. Governor, how can Europe stay relevant on this AI world?
Well, I think we're coming from behind. I totally agree, for sure. All the indicators show that. It's a bit disappointing because if you think about two other general-purpose technologies that took place in the last 30 years, both in terms of the development of the personal computer and then afterwards the internet, we were behind. And we didn't learn the lesson, and we are probably even farther behind than we were at the time. And so the question is what to do. So, of course, our companies will use AI and so on, and, I think we have a great education system and so on. But the question is whether we can develop the ecosystem that is necessary so that we also have European players at the highest level. And so, again, in terms of models, we have one or two companies that now they have an interesting model, but still a few months behind. We don't see the investment that we see in the United States. So I think, remember, just to give an idea, what a general purpose technology is something that will usually changes the whole structure of the economy, the way that we work. So we always give the example, classical work, when you go from from steam engines to electricity. If you remember, factories used to be 4 or 5 levels high because the steam engine had to be in the middle so that you developed power, whereas in electricity you plug it anywhere, so the factories had to be redesigned. So anytime we have a general purpose technology, usually there's redesigning of work processes. There's also relationships between people and workers and firms that change. It's innovation. Everything changes. So what we need to do in terms of, to catch up, I think, is certainly we need to catch up in terms of infrastructure, in terms of data centers, in terms of investment. We need to invest significantly amounts in this area. But I think also that we need to have a better attitude towards innovation. I think Europe, part is the answer. We're not channeling the capital that we need towards these areas. But I do think that very often the attitude is a bit a cliche, but it's true. In Europe, usually we tend to regulate first, and then we let innovation. The United States, Korea, and a few other countries prefer to let innovation flourish, then you adjust and you regulate. And I think we need a bit of both, but I do think that the attitude of our tendency sometimes to over-regulate and thinking about the fears rather than, and the challenges rather than the opportunities, it's something that we need to change in our mindset.
Perfect. Valentino, we were talking exactly about this point Governor mentioned about innovation first, regulation next, rather than the other way around over lunch. And one other thing you mentioned was the concern that every emerging idea here ends up moving towards the US very quickly. What do you think that Europe can do to try to retain that?
I think it was said before, we need a capital market, we need the ecosystem to scale up, not just for the startups. And thirdly, we have to change our mentality, and that's the hardest way because we are risk averse, especially in a country like ours, but imagine many others. We're we're an economy made up of small and medium and micro companies, family run, risk averse, and our capital, if you look at where money is deployed in this part of the world, they're deployed mostly in government bonds. When you have your yields are there, you don't touch them, no risk. Well, America is just the opposite. We would have to be a bit more less risk averse. Certainly, regulation could be used to invite institutional investors to invest more, as do the United States. But I think these are the 3 points. And the fourth is there should be a balance between regulation and innovation. Of course, you know the triad. American invents, the Chinese copy, and Brussels regulates. This time, I have the impression that Brussels tried to regulate even before having the innovation, trying to somewhat block a wave of innovation that is coming and habilitating technologies that is really changing the way we work. So I think we have to make an effort, all of us, to try and realize what Ricardo Mendes says. Well, we are bound, and I just finished. If you think about AI, practically, what is it? It's energy, compute power, models. I think where we can enter already now is models. That's where our company should work, and models application. Then, if we can, we go down to data centers and energy that is necessary. I also would like to invite you to think that another big innovation was the use of cloud computing. All of our innovations are on the cloud. We are not on the cloud, yet all our companies use the cloud. So I think we'll probably be in a situation with AI where we need and we must be applying, experimenting and using AI that will change not just the way we operate, but also we'll have to rethink totally the way we proceed in order to be competitive. And Europe does have the mind power to do that.
Klaus, very quickly, just to finish on this topic, do you think US-style equity pools in Europe would help bridging this gap in terms of the AI race?
Sure. I mean, to the extent we can copy what works in the US, that helps. But in general, let me repeat what Rishi Sunak said during lunch. Europe is not at the cutting edge of AI development, and it will not be. It's China and US. However, the gains coming from AI can be derived if we manage to use it well and widespread, and all that brings us back to what the governor said and Phil said. We need to complete the single market. We need to have the capital markets union to scale up, because there are small companies that try now to provide services in Europe that do not exist so far, but they exist in the US, but they are small. They don't find the money to scale up. So it always comes back to the same topic. It's like a broken record. Complete the single market, have the savings investment union. It will help to finance the defense needs that we have. It will help to finance the AI needs that we have. There's one more thing where we can learn from, I think, 5 EU member states that have capital-based pension systems, because the experience is very clear. This includes Sweden and Netherlands and a few others. Those countries that have a well-developed capital-based pension system, they have many more startups. It's a striking difference between those 5 and the others. The number of startups per capita and per 1,000 people, it's 10 times higher.
Does that also apply with sovereign wealth funds, you think?
I'm not sure it would go the same way, because sovereign wealth funds can be many things. And sovereign wealth funds, I don't care where they are located. If they are in Singapore and want to invest here, that's also fine. But so far they don't do it because we don't have the capital markets union. Okay. So it again comes back to that topic.
Can I just add something? I totally agree with Klaus. But remember, when you teach economics or you learn economics, you always say that Economics 101, the first lesson, people respond to incentives. It's not only people, also countries, right, and governments. Well, look at the European Union. Brussels, which I really think we have done incredibly well in the past few decades. But Brussels has one power, which is to regulate. Brussels has no power to tax or to raise revenues in other ways, through defense and many other areas that we have the state doing in a normal state. And so if you have only one power, what do you think you're going to do with it? You're going to try to use it. And so the incentive is there for us to overdo it. It's not only because we are Europeans and we tend to regulate more than others. It's probably true, but remember, we also had an amazing history of innovation. But I do think that here we have an incentive structure that is biased towards over-regulate. So, in my view, again, completing the federation, it's absolutely essential so that we are able to get a more balanced policy-making areas in the next few decades.
Very good. Let's now travel to Portugal and talk a little bit about our country. Klaus, the first time we spoke, I remember you told me personally that you regard Portugal as an exceptional European stability mechanism outcome, and you have mentioned already in your introduction. It was a program completed in around 3 years with results that exceeded expectations. What made it so quick, and looking back, what impressed you the most? And then at the end, I'm going to ask you whether Governor was a good counterparty to deal with or not.
No, we will keep some secrets.
Okay, good.
Exactly.
Well, when we all think back 15 years to early 2011, there was a serious crisis in these countries. There was a serious crisis in the euro area. We have to look back, and I mean, it all started a bit with the global financial crisis in 2008, which was a US problem, but our banking system was very much affected, like most banking systems around the world. So it weakened the European banking system overall. But then the homemade problems came up first in Greece, and in Greece more than in other countries, but also then in 2011, and in Ireland was the second country, then Portugal, later Cyprus came, and Spain came with a particular banking problem. So we had a serious problem in Europe. It was not only Portugal, but Portugal was very much part of it. And there were problems all over the place. There was, the fiscal deficit was too high, the debt level was therefore too high, financial sector had grown too fast, there were bubbles, basically caused by the low interest rates that came with the accession to monetary union. Competitiveness was lost, incomes had grown too fast, therefore there was a big trade deficit, not surprisingly. If there's a trade service deficit, current account deficit, that means the equivalent amount of money has to be imported from the rest of the world to finance this deficit. That's why countries like Portugal and Greece and Ireland had to rely on financial markets and with large numbers, and the money had to come continuously. And when financial markets had doubts about the sustainability of all of this, they stopped providing money, first to Greece, then to Ireland, then to Portugal. And that was a problem because the amount of money needed was quite large. And the amount of money that was then needed from the friends of Portugal and Greece and the other countries was huge. And we didn't have a mechanism to do that. We have always the International Monetary Fund that supports countries that lose market access. But the problem is that countries that are members of a monetary union have much closer financial relations with all their neighbors, which is logical. When you have the same currency, there are many more financial flows. And when they stop all of a sudden, then a much bigger amount of money is missing compared to a country in Asia or Africa that may need an IMF program. So the IMF was not able to do all of this. But then Europe got its act together. We always develop in a crisis, as we heard many times this morning. This was another example, and I think in the end a good example. We created new institutions, not only the ESM that I built up, first EFSF, then ESM. We also started banking union. We now have a single supervisory mechanism. The ECB is supervising all the systemically important banks. We created new supervisory authorities for banking, for insurance companies, financial markets. All that did not exist before the euro crisis. So we did many things. That was the contribution from Europe. The countries that were affected by the crisis that lost market access for a reason, they had to correct the mistakes of the previous decade. Basically, these mistakes had accumulated over a decade, the first decade of monetary union. It was a new environment. Borrowing seemed much easier, much cheaper. Interest rates were all of a sudden much lower. So governments borrowed too much money. Banks expanded too fast. Also other credit expanded too quickly. All this was not sustainable. So it had to be corrected. That is painful. Corrections, adjustments, reforms are more painful in a monetary union. Monetary union has many advantages, and we enjoy many of them now. But there's one disadvantage. When a country has problems like Portugal had 15 years ago, then the adjustment is more difficult because the exchange rate is not an adjustment variable. Therefore, the adjustment has to be done different ways, and that's very painful. But Portugal did that. There was a huge commitment, and that was your question, why I was confident that it would work. There was commitment. to do what had to be done. The government was responsive. We worked very well together with the governments, the finance ministers, and it worked. And already after 2.5 years, Portugal was able to access the market again, issue bonds. In Greece, it took 7 years. So just by comparison, the commitment was not quite the same. So in Portugal, it worked. And we see ever since that economic performance in Portugal is better than the average of the euro area, which for me was not surprising because I worked at the IMF for a while and I have seen in other parts of the world how it works. When there's a problem, the IMF is called in, often very late because no government does this lightly. It's not pleasant when somebody comes and tells you what to do. But there are many countries that did it successfully around the world. They got the money from the IMF, they implemented reform, and then for a number of years, they have a better economic performance than the rest of the world. So it pays off.
Yeah.
And that's exactly what we have seen in Europe, clearly in Portugal, in Greece, with some delays, in Ireland, in Cyprus, in Spain. So it has worked.
Perfect. Governor, I think you passed the question on being a good counterparty, but just asking you if you remember those moments. What was the hardest moment that you remember? And what made it work? How did you overcome that? And does it tell you anything about the ability of Europe in general to overcome these challenges when it chooses to?
Well, it was a very difficult period for everyone, but it was especially for the population, right? But we knew that we had to do two things. One is to reduce debt, both for the state, families, and enterprises. And the second thing was to reform. And I think one of the big lessons that we learned from the crisis, and in particular in our own case, is that even though we know that reforms usually take time, right? So when you do reforms, you cannot expect that this will have an impact immediately. In fact, probably it would take a few years. In fact, it did. And so we were doing reforms, with heavily criticized very often, with difficult reforms, labor market reforms, competition, insolvency, licensing, and many other areas, cutting down barriers to services and so on. And we did that knowing that the only way we were going to go back to growth, and remember, Portugal before the crisis had 20 years of not growing, or growing about 1% a year. If you grow 1% a year, it will take you 70 years, 7-0, to double your income, which means that neither you nor your kids are going to see any changes. And so you need to have growth in countries like Portugal and in Italy and other countries. You need to have growth. Without growth, you won't be able to have significant increases in standards of living. So at the time, I think the most important thing was reform ownership. We did reforms not because of the Troika, not because of the external disadjustment, not because of Brussels. We were doing reforms in terms of labor, competition, and so on, because we believe in the reforms. It's always a way, of course, there's the memorandum of understanding. And we could always say, well, tick the box in terms of rents or other rental reform or labor or something like that. You tick the box and you pretend that you do the reforms and you don't implement them. We did. We did it because we believe that by doing the reforms, we are going to turn things around, and this is exactly what it did. And the other thing that was, I think, absolutely essential was the commitment to reduce indebtedness. You look at today, Portugal, this year we'll have a debt to GDP ratio lower than Austria. We have a debt to GDP ratio much lower than Spain, France, Italy, Greece, and many other countries. And again, you look at families, you look at enterprises, it went down quite dramatically. And we learned the lesson the hard way, and this is why going back to the hard times. But I think it's important that we do not forget the mistakes of the past, and we continue to lower debt in the next few years. At the same time, I would like us to go back to reforms, because we cannot grow more and increase the standards of living of people unless we reform.
Perfect. We are approaching the end of this session. I wanted to ask one question, and then I'm going to ask one question to every participant. Governor, just staying with you, in January, you mentioned that ECB monetary policy had done what was needed, or has done its job, and no need to change rates. Since then, energy prices have spiked, we have wars, inflation is heading back towards 3% across Portugal and Italy. The Fed is on hold at 4%. Is the Europeans' economic outlook for the next 2 years one of confidence or caution? And how do you project the evolution of inflation and interest rates? If you could just share a little bit your view of.
Well, the ECB is projecting that we'll be a bit above 30% in 2026, and then we'll come down in inflation. I think it's going to depend how the conflict is going to evolve. It's going to depend whether we're going to have another shock. Remember, in the last four or 5 years, we had COVID, then we had Ukraine invasion, then we had tariffs, now we have this. So a lot of shocks, and our economies have been fairly resilient. I think the focus right now is on inflation. We know what happens when we have a lot of inflation. That means it's a tax on income, it's a tax on people, and so we need to make sure that price stability is ensured, and this is what the ECB will certainly do in the next few months and years.
Phil, just 30 seconds on this topic, no constraints. Confidence or caution for Europe in the next 2 years?
Well, I think I remain confident about Europe that eventually they are getting their act together. Thanks to 2 former Prime Ministers from Italy, they've set the roadmap, Mr. Draghi and Mr. Letta. That's a big change for Italy, but it is a very welcome one. And Europe eventually are getting around to implementing it, albeit a bit too slowly. But the system doesn't lend itself to speed. It lends itself to, it needs to lend itself more to agility to deal with these important issues of competitiveness and investments and research and innovation that we spoke about earlier. But I'm optimistic. Like, look at what's happening in the UK. The UK, because they're not in the European Union, are at a big disadvantage. Now they want to come back, some people, into the European Union. So we're going to have a discussion, I think, at the European level to know, are we going to be dealing with Prime Minister Starmer? Are we going to be dealing with Prime Minister Farage? Or who are we dealing with? This is the big problems and conversations that we're having in Europe now about our closer relationships. But that's a good example of where we do not want to be. And I think, and the final thing I will say is that when you see all of the various extreme political parties that are emerging in some parts of Europe, all of them said, let's get out of Europe, let's get out of the euro. None of them are saying that now. They're saying we stay in Europe and we reform from within. So I'm optimistic that politics is beginning to grow up and becoming more mature.
Perfect. I think you all have done a great job of staying positive and optimistic, so thank you for that. It's quite an achievement when we have 4 incredible economists on stage. I wanted just to finish with all of you, but I ask you really to keep it to 1 sentence because we're out of time. One message of genuine hope about Europe's future, not a policy prescription, just a reason for confidence. What would it be? I'll start with you, Valentino.
Okay, 2 past Prime Ministers already have given prescriptions to the rest of Europe. The only thing that leave office in order to do that. Having said that, I'm going to borrow a sentence from Warren Buffett. I will use it about Warren Buffett used to say, never bet against America. I'm going to say, never bet against Europe. That's the only thing I can say.
Thank you. Klaus?
When I look at the world today, Europe is the best place to live. We can improve it further, but we should be quite proud to be here.
Fantastic. Phil?
Very proud, in line with what the previous speakers said, very proud to be in a continent where we have reliable rules, we have good quality of life. We have a few things to do, but what continent doesn't?
I'll finish with you, Governor.
Well, this is the best continent. We are all biased, but this is the best continent in the world. We just need to make sure that we are not a beautiful museum or a home care, and we are an area where we have thriving innovation. So I believe what makes me confident is Europeans, European people. I think we have that drive. We just need to let it flourish.
Perfect. The question of how Europe prospers in the new world order has no simple answer, as we know. But there are multiple examples led by people in this panel that it can be done. So thank you so much, Klaus, Governor, Phil, and Valentino for joining us today. And it was a real pleasure. Thank you very much.